Inflation isn't an accident. It's a feature. Right now, as you look at the price of, let's say, a comically oversized novelty cowboy hat, you might feel a sense of bewildered rage. You'd be right to. It feels random. One day your money buys a hat, the next it barely covers the tassel. It feels like the economy just woke up on the wrong side of the bed and decided to punch you, specifically you, in the wallet. But here's the thing, and this is important. That feeling of chaos is a carefully constructed illusion. The truth is, inflation is less like a wild storm and more like a controlled demolition. There are people, important people, in very serious-looking buildings who have their hands on the levers. These are the folks at central banks and in government finance departments. They aren't just sitting around watching prices go up like it's a spectator sport. They are actively managing the economy using a specific set of tools. These tools are designed to influence how much things cost. The process is complicated, sure, but the outcome is often intentional. They might be trying to prevent a recession or boost employment, but a side effect, and sometimes a direct goal, is making prices rise. So, while you're staring at a grocery bill that looks more like a hostage ransom note, it's not just the economy doing its thing. It is the result of a series of deliberate decisions. Decisions about how much money exists, how much it costs to borrow that money, and how the whole system is tilted. This isn't a conspiracy theory, it's just economics, but the kind they don't usually put on a cheerful infographic. This essay is going to pull back the curtain on this whole sordid affair. We'll look at the tools they use and, crucially, who gets rich and who gets screwed when the machine is switched on. Because that's what it is, a machine. A machine designed to move money around. And the most remarkable thing about this machine is that it operates in broad daylight, while most of us are too busy arguing about the price of eggs to notice who's collecting the golden ones. It's a system where your savings can evaporate, not because you made a bad decision, but because someone else made a very deliberate one on your behalf. So let's get into how this magnificent, infuriating, and deeply unfair system actually works. Let's go. First up, let's talk about the money supply. This sounds incredibly boring, I know, but stick with me, because it's the monetary equivalent of learning how a magic trick is done. The money supply is simply all the money sloshing around in the economy. Now, you might think money is just printed paper, but most of it is digital, created with a few keystrokes. Central banks, like the US, are the masters of this digital domain. They have a tool called quantitative easing, which is a fancy term for making money go brrr. Here's how it works in its simplest form. The central bank decides the economy needs a little juice. So, it goes into the financial market and starts buying things, usually government bonds, from big commercial banks. It doesn't use existing money to do this. No, it creates brand new, fresh out of the oven digital money to make the purchase. Suddenly, those big banks are flush with cash. They're sitting on giant piles of new money, and a bank's job is to lend money out, not use it as a very expensive mattress. This is the first step in the inflation playbook. With all this new cash, banks are eager to lend. They lower their lending standards and offer loans to businesses. They lower their lending standards and offer loans to individuals. That business that wanted to expand, approved. That person who wanted a mortgage for a house with an adventurous foundation. Here's the money. This flood of new credit means more people and companies are out there spending. They're buying equipment, hiring staff, renovating kitchens, and yes, splurging on those oversized cowboy hats. And what happens when more money is chasing the same amount of goods and services? You guessed it. Prices go up. This isn't necessarily a mistake. It's often a calculated policy choice. If an economy is sputtering and unemployment is high, a central bank might inject money to stimulate demand. The goal is noble. Get people back to work. But the consequence is that the value of each individual dollar you hold goes down. It's a trade-off. They are essentially choosing to devalue everyone's cash savings to try and spur economic activity. They are creating inflation on purpose, hoping the benefits, like more jobs, will outweigh the cost of your money buying less. Right? So that's how it happens, more or less. Next on our tour of economic dark arts is the interest rate. If the money supply is the gas pedal, interest rates are the brakes and the steering wheel combined. An interest rate is simply the price of borrowing money. It's the fee you pay to use someone else's cash for a while. Central banks have the power to set a key benchmark interest rate. That benchmark then influences every other rate in the economy, from your credit card to your mortgage to your car loan. And they play with this rate like a toddler with a shiny new toy. When the central bank wants to speed up the economy, it slashes interest rates. Suddenly, borrowing money becomes incredibly cheap. It's like a massive everything must go sale on debt. Businesses see these low rates and think, now is the perfect time to build that new factory or buy that fleet of delivery drones. Individuals think, wow, I can finally afford that house with the questionable plumbing. This rush to borrow and spend creates a surge in economic activity. More spending leads to more demand, and this pushes prices higher. Inflation gets a nice, big push. Conversely, when inflation gets too hot and prices are rising faster than a celebrity's ego after a hit movie, the central bank can slam on the brakes. It does this by hiking interest rates. Borrowing suddenly becomes expensive. That mortgage payment doubles. That business loan looks terrifying. Faced with high borrowing costs, both people and companies cut back on their spending. They save more and borrow less. The economic engine cools down, demand for goods and services falls, and in theory, inflation begins to slow. This constant fiddling with interest rates is a delicate and often clumsy balancing act. Cut rates too much, and you get runaway inflation that hurts everyone. Raise them too high, and you can tip the entire economy into a recession, costing people their jobs. But the key thing to remember is that every single change is a deliberate choice. These rate adjustments directly reward certain groups while penalizing others. By making debt cheap, they encourage borrowing. By making it expensive, they encourage saving. And in doing so, they are actively steering wealth and opportunity around the economy. So yeah, that's the seesaw. Now we come to a particularly cruel part of the inflation machine, the wage lag. This is the frustrating phenomenon where the price of everything you buy goes up long before your paycheck does. Hook graphic. Timeline. Prices shoots up. Wages trails. Gap labeled purchasing power loss. Imagine you're in a race. The prices of gas, food, rent are all professional sprinters who took off the second the starting gun fired. You, representing your wages, are still tying your shoelaces, wondering if you're even in the right stadium. By the time you get a raise, the finish line has been moved another mile down the road. This happens for a few very simple reasons. Prices can change overnight. A gas station can update its sign in minutes. A grocery store can change the price of milk with a new sticker. But your salary? That's a whole different story. Many people's wages are locked into annual contracts. Your boss isn't going to call you in every week to adjust your pay based on the latest inflation report. You might have to wait for a yearly performance review, or even for a union to renegotiate a multi-year contract to see any increase in your earnings. This built-in delay creates a gap, a period where your purchasing power is actively shrinking. Every dollar you earn buys a little bit less than it did the month before. For people living paycheck to paycheck, this isn't a minor inconvenience. It's a crisis. It's the difference between affording groceries for the week and having to make tough choices. This wage lag effectively acts as a temporary tax on anyone who earns a salary. Your nominal wage, the number on your pay slip, might stay the same, but your real wage, what you can actually buy, is falling. This isn't some unfortunate bug in the system. It's a fundamental feature of how our labor markets work. For businesses, this lag can actually be a temporary benefit. For a while, their costs, your wages, stay flat while the prices they charge for their products are going up. This widens their profit margins. So while you are feeling the squeeze, the company you work for might be enjoying a period of increased profitability. It's another way the system is tilted, creating a situation where the value of your labor is eroded for someone else's gain. So, if inflation is a machine for moving money, who ends up with more? And who ends up with less? Let's break it down by looking at three distinct groups: the saver, the asset owner, the debt holder. First, consider the saver. This is the person who did everything they were told was responsible, worked hard, lived below their means, put money into a savings account at the bank. In a high inflation environment, this person gets absolutely demolished. The interest their savings account earns is almost always lower than the rate of inflation. If inflation is 5% and your bank is generously giving you 1% interest, you are losing 4% of your money's purchasing power every single year. This primarily hurts retirees living on a fixed income, cautious, working-class people who keep their wealth in cash. They are playing by the old rules in a game where the rules have been secretly changed. Their financial prudence is punished. Next, we have the asset owner. This is someone whose wealth isn't in a bank account but is invested in things: real estate stocks, fine art, or a warehouse full of rare Beanie Babies. This person often comes out way ahead. Why? Because the price of the stuff they own tends to rise with or even faster than inflation. The value of their house skyrockets. The stocks they own go up as companies pass on higher costs to consumers and post record profits. Inflation doesn't destroy their wealth, it inflates it. Finally, let's look at the debt holder, the borrower. This one might seem counterintuitive, but borrowers can be major winners. Imagine you took out a $300,000 mortgage 10 years ago. Today, thanks to inflation, $300,000 is worth significantly less than it was back then. However, your debt is still fixed at that original amount. You are paying back your loan with cheaper, less valuable dollars. Inflation is silently eroding the real value of your debt. This is especially true for large-scale borrowers, like corporations and most notably governments, which are often the biggest debtors of all. To truly understand the impact of these mechanics, you need to visualize what's happening. It's a quiet heist, a massive, silent transfer of wealth that happens without a single law being visibly broken. Imagine three large pools of water representing the wealth of our three groups. The first pool belongs to the savers and wage earners: cash, savings accounts, fixed income pensions. The second pool belongs to the asset owners: stocks, real estate, other tangible things. The third pool belongs to the debt holders, representing the value of their fixed loans. When the inflation machine is turned on, several pipes open up between these pools. A large pipe, labeled purchasing power drain, begins siphoning wealth out of the saver's pool. The water level drops visibly. This water doesn't just evaporate. A portion of it is redirected through a pipe labeled inflated asset values and flows directly into the asset owner's pool, causing its water level to rise dramatically. Their houses are worth more, their stock portfolios are booming. They are absorbing the wealth that is draining from the savers. Simultaneously, another process is underway for the debt holders. A metaphorical heat lamp labeled inflation is placed over their pool of debt. This causes the real value of their debt to evaporate. The total amount of debt doesn't change, but its weight, its burden, shrinks. This is particularly beneficial for the government, which has a colossal pool of debt. Inflation helps the government burn off its obligations, making it easier to manage its finances without having to raise taxes or cut spending in a politically unpopular way. This entire redistribution happens without a vote, without a debate in Parliament or Congress, and without most people even realizing what's happening. It's a transfer of economic power from the cautious to the leveraged, from labor to capital, and from the old to the young, who tend to be borrowers. It rewards risk-taking and asset ownership while penalizing cash savings and financial prudence. It's a policy that fundamentally reshapes society's financial landscape, all under the guise of managing the economy. It's not an accident. It's the very point of the design. So, let's recap this whole mess. Inflation makes your coffee more expensive and makes your mood considerably worse. It's not a mystery. It is the predictable outcome of a set of tools. Controlling the money supply, tweaking interest rates, leveraging the natural lag in wages wielded by central banks and governments.